talk about the economy. So I'm curious to hear your current view on interest rates, because we all know that real rates are one of the biggest drivers of gold returns and hopefully down the road, Bitcoin returns. Could you just help us understand the moving parts of the U.S. economy that will determine if the rate path is higher for longer, or if the current cuts that are priced in, I think there's cuts priced in starting in March, will they come true?
Well, first of all, important to recognize gold is non-interest-bearing money and generally will perform more weakly when real interest rates and interest rates in general are elevated, though, gold is pressing new highs at a time when interest rates are, gold is pressing new highs basically at a time when interest rates were very close to their peaks. And so it's actually performed really, really well. When it comes to the dynamics going on in the economy, in a lot of ways, we're sort of still on this path of the nominal growth in the economy is still very strong relative to what is necessary for the Fed to meet its mandate. And so measured inflation has come down. That's created a lot of expectations that there's going to be interest rate cuts immediately into the economy. For instance, very simple, which is that like 5 to 6 cuts are priced into 2024. I think that's really interesting. That's a really interesting dynamic because nominal GDP growth for the third quarter was something like 8%. I mean, that's very, very high in the U.S. economy. It's expected to grow in the 5 to 6% range for the fourth quarter. So you put that together, the economy is still too strong relative to what's necessary for the Fed to durably bring inflation down to its mandate. And so that likely means that we're going to continue to see elevated interest rates. And that slide just basically showed like what needs to happen to get us to the point where the Fed has actually brought inflation durably down to 2%. And that's a dynamic. That's a series of steps where first interest rates have to be elevated, then stocks fall, then, basically people spend less, then earnings weaken, then employment weakens, then wages weaken, and then nominal spending comes back down to the Fed's target. In that process, we're still very early, and a lot of what's happened over the course of the last 30 days basically has set us back in that process by creating a financial market easing rather than forward in that process. And so really it's important, I think a lot of people are buying bonds to try and get ahead of what might be weakness in the future. But important to recognize that order, because the order is what's going to drive what happens, which is first yields have to rise, then stocks fall, then that kicks off the recessionary process. And so buying bonds today, before you get those set of steps starting to work, is premature. And I think people will find that out, as they have, frankly, for the last year, over and over again.